I'm Franklin Allen. I'm Professor of Finance here at Imperial. So this session, I think, is an important one. If you look at what's happening in Europe at the moment, what we see is that there's a lot of prevarication about the politics of climate change. If you think about the auto industry and whether or not we're going to have internal combustion engines banned from 2035 onwards, we started to get a great deal of pushback in Germany, in Italy, and many other places. And of course, in the UK, we pushed it back from 2030 to 2035. And I think this is an important aspect of the whole problem, is that the political side of things are under stress. And I think finance has a very important role to play in terms of doing things which aren't mandated by the government. People can make their own free choice about supporting climate change initiatives. That's essentially what we're going to be talking about here, is some things which are not mandated by the government, but are more in the way of voluntary things. And we're going to start with Dr. Robin Döttling from the Rotterdam School of Management at Erasmus University, Rotterdam. So, Robin,
thank you.
Go ahead.
Okay, thank you very much. Thanks for having me. I'm very excited to be giving this talk. So, as just announced, it's going to be a bit of a pace of change. So, it's going to be a bit more research focused on the academic work I've been conducting and Adelina has been working on. In particular, I'm going to talk about a recent research project in which we look at voluntary commitments, green commitments by banks, and how that affects loan outcomes. And I should point out this is joint work with my co-authors Tobias Berg and Xander Hood at Goethe University and my colleague Wolf Wagner. So the motivation for this research project was that we see many lenders making what we broadly call green pledges. This can be, a wide range of commitments, such as climate disclosure, climate risk management, or it can be like an impact pledge that you want to support the net zero transmission. Just to give one recent example, recently the Net Zero Banking Alliance was launched, which now covers a lot of the global banking assets. So in this paper, what we want to try to do is estimate: do such green pledges, do they have a causal impact on green loan origination? And we're not the first to ask this question. So before getting into that, I want to give you a bit of an overview where the literature stands on that question. Okay, and if I were to summarize it in one word, if you want, I would say the evidence is mixed at the moment. Yeah, so for example, this paper by Martin Kacperczyk, who will speak later, also give the keynote, looking at the Science-Based Target Initiative, SBTI, and look at when banks sign up to that, what happens to their lending, and they find they reduce lending to brown firms. Okay, they reduce lending to brown firms, but it does not seem to lead to an improvement in borrowers' environmental performance. Another paper I'm listing here by Hassan et al. They looked at the TCFD. Here they also see that there's a reduction after signing up to TCFD. There seems to be a reduction in lending to polluting firms. Another paper by de Grace et al. Looking at the United Nations Environmental Program Finance Initiative. And what they observe is a reward in terms of loan pricing. So there seems to be cheaper loans by these signatories to firms that also signed the TCFD. Then recent paper by Sastry et al. Looking at the Net Zero Banking Alliance, and here actually now the result looks a bit different. Here they don't find any effect of that on relative lending to green versus brown firms. Another paper I want to mention is Giannetti et al., the last one here on the list. They basically read banks' annual and sustainability reports, and what they find is that banks that emphasize sustainability a lot in these reports actually counterintuitively lend more to brown firms. Okay, so overall it seems to be mixed evidence. What is the effect on green and brown lending, and then also what are the real effects of that? And partly that's because it's a very difficult question to answer scientifically. So why is it a difficult question? I want to highlight 3 reasons here which I think our research project can speak to. First of all, as a researcher, we can observe banks making loans to firms, and we can see whether that's like a green firm or a brown firm with a lot of emissions, for example. But we don't know exactly what expenditures this loan funds. Yeah? So it could be actually that the most climate-friendly thing is to lend to a very brown firm that then makes a green investment. So we cannot distinguish that very easily. Second, corporate loans don't necessarily always fund the most climate-relevant activities. And third, the decision to sign up to one of these initiatives is, of course, endogenous. What do I mean by that? If you're like if you're a bank that's very committed to decarbonization and so on, then you're probably more likely to sign up, and you signing up might just be signaling that you're actually you would have been a green bank either way. You would have reduced loans to brown firms either way, whether you sign up or not, because you just happen to be that type of bank. So this research project I want to talk about is we're going to ask this question again, but in a new setting. And the setting we will focus on is the project finance market. In the project finance market, there is a key green initiative called the Equator Principles. And we think that this setting can help overcome some of the challenges. Okay? First of all, in the project finance market, projects are typically organized as single-purpose vehicles. So each loan funds a very specific project. So we can directly tie the loan to the expenditures to the project that is being funded. So that's very good from an empirical research perspective. Second, this is actually a very important market for climate change. Yeah? So this is really financing large-scale projects like coal power plants, renewable energy, wind farms, and so on. Exactly the stuff that's going to be really important for decarbonization. Third, we can address this endogeneity issue by looking at a change in the Equator Principles that happened in 2020. So in 2020, the Equator Principles were updated from version 3 to version 4. And that allows us to disentangle the effect of the requirements laid out in this pledge from this more endogenous decision to sign up to the pledge. Okay, so let me talk a bit more about how we measure the environmental impact of the projects. So we can observe what projects the loans funded by banks finance. And for each project, we have a purpose description. So this is a text describing the project. Okay, just here's some examples on the slides. For example, you can read something like, the proceeds are used to finance a wind turbines project. Or the funds are to build a refinery. Yeah? And again, I want to highlight, this differs from using borrower-level measures. Yeah? If you just look at, do you lend to a firm with a low ESG score or a firm that has a lot of carbon emissions? Because here, it can really be that brown firms are the one making these these green investments and investing in green projects. Here we can directly see what project is being funded. So I think that's very important. So how do we do that? Well, it's this textual information. So we have to do something to analyze that, and we're going to have 2 approaches. The first approach will just focus on a subsample of the deals, which are energy related. And these are quite easy to classify because we can quite easily see, we just distinguish between renewable versus fossil fuel energy. So we can do that based on a simple keyword search, which then, if the keyword search is ambiguous, you can follow it up with manual checks. But you can, easily do that on a large data set. And it has relatively small measurement error because it's quite easy to tell, is this renewable or fossil fuel energy? There's very little measurement error. But we're just using a subsample, okay? Therefore, we've complemented that with a second approach, which uses the full sample of projects that have been financed. So here, there's going to be more information. It's going to be hard to assess. We have thousands of projects. So what we do is we actually use the recent advances in large language model, specifically using the GPT-4 OpenAI API, to basically just let GPT read the description of the project and tell us, does this have positive, negative, or neutral environmental impact? Put differently, is it a green, a neutral, or a brown project? Now this obviously has more measurement error, yeah? So we're going to get some classifications wrong, but the benefit is we can use the whole sample. Okay, so what we're doing is we're using these two approaches, one little measurement error, small sample, and the other one more measurement error, but a big sample. To reduce measurement error, we also manually check a subset of deals. We're quite careful with the prompt engineering. We put quite some work into that. And we also, reran this classification several times, and we saw that the classifications are relatively stable over those iterations. Okay, then the other thing I need to tell you about is this green initiative in the project finance market. And that's the Equator Principles. So the Equator Principles are a risk management framework focused on environmental and social risks in the project finance market. It's actually started quite a while ago in 2003, and as of December 2023, it has 138 lenders signed up. It's relatively large in project finance, so 60% of our sample is covered, and applies globally to all industries and projects financed under certain criteria. There's also a secondary motive to kind of have positive impact, contribute to the transition, but at the core, it's really a environmental social risk management project. And what we're going to do here is we're not going to look at the sign-up of a bank to this initiative, but we're going to look at a tightening of that initiative, so a change in that initiative, from version 3 to what's called version 4, EP4, that happened in October 2020. So what happened there? So in EP4, a lot of things were changed. So we talked to some people in the industry who work on this, and if there are people in the room who work on project finance, I would love to talk to you later how you perceive this change from EP3 to EP4. Our understanding, based on talking to these people, is that the key new requirement is that the climate risk assessments to new PF loans, private project finance loans, were tightened. So you have to do much more comprehensive climate risk assessments. That's required for projects with large environmental externalities, which we argue increases the cost of brown polluting projects relative to green projects. So we focus on this tightening. So the tightening of this pledge for existing members. Yeah, so this affects all the existing members. And what's nice about this from a empirical researcher perspective is that this is plausibly exogenous to the banks that already signed up in the past. Yeah? So we're going to quantify the causal impact of these green requirements on loan outcomes, and what we're going to do is essentially a difference in difference estimation, meaning it's basically like it's a natural experiment where we're going to have a treatment group and a control group. Who is the treatment group? The treatment group are all the banks that were already signed up to the Equator Principles, and they are now facing this tightening of the requirements. The control group is the banks that are not signed up to the Equator Principles. Okay, so we can look at the lending relative of these groups around the introduction of EP4, and we have a control group and a treatment group. And we're going to do lender level and loan level analysis. Okay, so this is the main result. Don't worry, that's the only table I will show you, and the only equation. So this is basically the main result. So we're going to look at the ratio of renewable to fossil fuel projects, or the ratio of green to total, or neutral to total, or brown to total projects that a bank finances. And again, this is based on this textual classification using GPT or the keyword. So we're going to look at that, and our key coefficient here will be the beta in the equation, which is the treat times post coefficient. So what does it tell us in simple words? It tells us how does the lending of EP members change around the introduction of EP4 relative to non-members. Remember, non-members, that was our control group. Okay, so the first two columns show you this for renewables relative to fossil fuel. We have a ratio based on just the number of deals and the ratio based on the value of the deals. And the result is basically zero. Okay, it's a small number. It actually changes sign depending on whether you measure number of deals or value, and it's statistically insignificant. It's not distinguishable from 0. So there doesn't seem to be a differential change by EP members relative to non-EP members around the introduction of EP4. Moving to columns 3 and 4, you see basically this similar effect for the GPT-based analysis using the green ratio, so the ratio of green projects to total projects. We see a small negative number, but again, it's statistically insignificant. And if anything, there's a reduction. If anything, it's a negative number, meaning EP members make less green deals. Neutral ratio, again, statistically insignificant, not different from 0, and the same for the brown ratio. So the number of brown deals also doesn't seem to change significantly. So if you look at, we can also look at this dynamically. So you can look at this in a picture. So this is just showing the same result over time, kind of shown. There's no big difference. There's no big pretend. And after the introduction of EP4, there is no differential change in lending by green and brown firms. Now, one concern you may have is that we have our empirical specification wrong. So one additional thing I just want to show you before I wrap up is we test whether this null result we have is sensitive to modeling choices. So the empirical model we have. So we basically rerun our analysis using thousands of alternative specifications. Usually looking at different geographies, fixed effects, how we define exactly the treatment, and so on. And you will find you will sometimes find a negative statistically significant coefficient, but really the bulk of the estimates of this exercise tells you there is no effect. Okay, so this we think really underlines that there's no effect of the EP4 titan. We also do this. You can see it in the paper. This is based on lender level analysis. We also do it on loan level analysis. So we also see there are no robust evidence that EP members shift from brown to green lending after EP4. Okay, so let me wrap up. So what we do in this paper, basically, we look at the impact of a tightening in the green initiative, so within the initiative change from EP3 to 4 on credit allocation in the project finance market. We think this is an important new setting because it's important for climate change. We can cleanly measure the environmental impact of the loans, of what they fund, and we can identify the causal impact of these climate risk managements that are being introduced. There's no robust evidence for a shift to greener loan origination. Let me caveat one thing here that that doesn't mean that the equator principles are ineffective, right? So it's a risk management framework, so it could still be that EP members now have improved risk management practices, or that they simply pick browner projects that are easier, have lower risk. So we cannot say anything about that. But the results, also together with the literature I showed you in the beginning, put at least some doubt on whether these private initiatives alone would be enough to incentivize green lending and financing of green projects. Okay, with that, thank you very much, and let me conclude. Stop here.
Our second speaker is Adelina Barbalau from the University of Alberta.
Hello. So I'm Adelina, and I'm truly happy to be here. I'm at my alma mater. I did my PhD here, so very, very happy to be here and tell you about my research. So the title of my talk is pretty much the title of the session. I won't be talking about an individual paper because I do theory, and I'm not sure we want to go there necessarily after lunch with no coffee. So instead, I'm going to highlight two takeaways from two papers. It's going to be based on joint work with Federica Zeni and with Franklin here. And it's going to be two themes that I'll talk about. One is the design of green securities and the trade-offs involved in issuing, say, a security like a green bond or one like an SLB, sustainability-linked bond, and also think about how we should maybe design optimally a security. And the other theme relates to the interaction between these type of instruments and financial markets and regulation through carbon pricing using regulation. All right, so let me start with the sort of like a background. the background is, if we're talking decarbonization, we've known for a while that the solution would be to put a price on it, tax it. But as you can clearly see from this image, the regulatory landscape is pretty fragmented. There's a lot of heterogeneity across countries with respect to whether they have implemented some carbon pricing regulation, the form that it takes. We have carbon taxes in some countries, we have ETS in others. In a few we have a combination, but by and large, there isn't that much happening. And there's a lot of reasons behind this, an important one being the lack of political support and political frictions that are standing in the way of implementing these kind of regulations. But this is something I'll get back to, I'll return to. But of course, there are many others, preferences, social equity considerations related to the fact that countries that have contributed the least are suffering the most, are also playing an important role. So yeah, that's the state of regulation. Hopefully you can see this. This is a map that shows the carbon price implied by those regulatory tools in the countries where regulation has been implemented. And what I want to highlight here is one, the high degree of heterogeneity and the lack of ambition. Like all these, even in countries that are the most ambitious, if I can say so, the price of carbon is still below the consensus of what we need. Okay, so against this background, there have been a lot of activity and developments in financial markets. I'll be thinking in particular about debt markets. So here I'm showing you the evolution of sustainable debt markets. And as you can see, there has been a sharp increase in the last decade. The proliferation of products to this market has started with securities like green bonds. And they have dominated the market for a while, but then since 2018, we see the emergence of other types of products. So, okay, they have sort of different names. There seem to be quite a few, but fundamentally, we're really talking about two underlying security designs. One is what we call project-based security designs. These include green bonds, loans, social and sustainability bonds. The focus here really is on pledging the proceeds to financing specific projects. It's a bit like the sort of loans that Robin was talking about. So you're committing the use of proceeds, you obtain a green label or whatever other label, and essentially the coupon or the interest rate is fixed. It's independent of any type of outcome that might be achieved by spending that money. On the other hand, those that are highlighted in red, sustainability-linked loans and bonds, they are general purpose instruments. There's really no concern or nobody cares what you do with the money in some sense. They're not linked to specific projects, but instead you have target outcomes. Most of the time these outcomes take the form of carbon emission reduction targets. And then the security payoff, so the coupon or the interest rate is going to vary over the life of the security depending on how your achieved outcomes relate to the target. So very quickly, to give you a sense here, we have a green bond. On the left, issued by EDF. At issuance, you select and verify the project. In this case, it's wind farms. The proceeds are put in a dedicated account. The interest rate is set and remains like that. At maturity, you report the use of proceeds. So you're basically reporting accounting information. And that's that. On the other, in red, we have a sustainability-linked bond. Here, you don't select a project. You select a green outcome indicator. In this case, it's Scope 1 emissions. The proceeds are general purpose. You can use them for whatever you want as long as you meet your target, right? So in this case, we have this step up, but they can go either way, up or down. And if you don't meet your target, your interest rate increases. At maturity, you report your green outcome, your emission reduction achieved, and that's that. All right, so the first set of questions that we thought about in the first paper has to do with what sort of drives these security designs? We see like opposite kind of design. So first of all, why has the market started with project-based security designs like green bonds? They don't seem necessarily efficient because you tie the action of the borrower ex ante and by committing to specific projects. And it's also not obvious why you should focus on intentions or actions when it comes to financing the transition. And then they're in line with theory, they're not in line with theory, but securities like outcome-based security designs like sustainability-linked bonds would embed these type of contingencies basically an interest rate that depends on your outcome that would sort of solve these problems. They have been implemented already, so it's not entirely clear why we don't observe, again, a switch to this other form of financing that in theory it's optimal. Instead, we observe a coexistence. So we want to understand this aspect too. We want to understand what explains these observed security designs, and importantly, we want to think about what would be an optimal security design, essentially. Okay, so let me describe a little bit the world the model, the world we're gonna capture here in our model. First, developing this theory of optimal security design relies importantly of capturing the key characteristics of the green outcomes you want to obtain, essentially. So we consider three. One is green outcomes are uncertain. We're developing new technologies, especially in the transition phase. There's technological, there's regulatory uncertainty. There's also uncertainty at a firm level with respect to their ability to operate these new technologies. So they're uncertain. Second one, we want to allow firms to deliver green outcomes through various strategies. So at one end of the spectrum, you can think of investments in tangible projects like solar panel, like wind farms, solar panels. So these are tangible projects. At the other end of the spectrum, you can think of effort-based strategies like the adoption of energy management system, changes in business practices aimed at reducing energy consumption, for instance. So we're going to allow firms to do both. And then the third one, the measurement of green outcomes, is difficult and subject to greenwashing. I don't think I need to justify this too much in light of what we talked about already. Okay, so we put these ingredients of green outcomes in a model in which we have an investor that values green outcomes. So they have green preferences, and they contract the job of actually implementing these to a profit-motivated firm. So we have this conflict of interest. Essentially, we have a moral hazard problem here, and we allow the firm to do three things in order to deliver green outcomes. They can implement tangible projects, they can implement effort-based strategies, and they can also greenwash, essentially. So the green outcome that the investor observes at the end, it's going to be made up of these three components, and they cannot tell which is which, right? Another thing that we assume the investor can verify is if the project has been implemented. So at the end, what you observe is the green outcome reported and whether the project has been implemented. It's a yes or no type of thing. Okay, so what do we find? First, let me start off with the optimal design of the optimal contract. Basically, is going to be a hybrid of what we currently observe in the market. It's going to have a payoff component that depends on outcome. This is what we call an outcome contingency, very much like SLBs do. And it's going to have a payoff component that depends on project implementation choices, which is something that green bonds feature. So the point of this outcome contingency is to incentivize effort provision. The issue is that it also incentivizes manipulation because you can get, your payoff depends also on this. So that's why we need the project contingency in order to restore efficient project implementation, or in other words, to make sure that the firm implements the right projects, essentially. So the more severe the level of greenwashing, the more likely you are to manipulate reported outcomes, the more relevant this project contingency component becomes. So essentially, in the limit, in the world in which basically we're not really able to measure green outcomes, we have to rely on specifying what we're going to use the money for. That's what explains green bonds in some sense, the fact that green outcomes are really not measurable. You have to make the contracts only contingent on project implementation choices, and you have to make this ex ante. You can't say, okay, tell me afterwards what you did. It's not going to be incentive compatible. Then if manipulation is not possible, the best thing to do would be to issue a security like an SLB, make things outcome contingent. So this is going to be the first best. But in reality, we have these two types of security design, and we also have the possibility to manipulate. So basically, what's the key trade-off involved in issuing one or the other in the reality we live in? Well, issuing a sustainability-linked bond versus a green bond has the advantage that it's flexible. You don't have to commit ex ante to specific projects. You can also exert effort and have this performance-linked payoff. The disadvantage is that, well, investors are going to anticipate that you can possibly manipulate the outcome, and they're going to price this accordingly. So, for instance, in industries where there's a lot of concerns about greenwashing. This distortion discount is going to be too high so that you're not going to issue a green bond, essentially. So really, this is it on the design of green securities. Now, I'm going to take you back to where I started, basically, the issues related to political friction. So here in blue was the map which I showed with the regulation implied carbon price. And then in green, I'm showing you the percentage of sustainability-linked debt relative to all debt issues in 2013 across the world. And anyway, the takeaway here would be, you have some countries in which you have active markets for sustainability-linked debt, that is debt which is linked to the emission reduction of the issuer, and you also have taxes. But more importantly, markets seem to be more widespread than taxes. So markets have a wider reach. So this led us to try to understand the following thing. Basically, we wanted to understand the role of markets, and in particular, the role of these financial instruments that are written on carbon emission reductions, and the interaction between these and regulatory rules for pricing carbon. And importantly, we wanted to take in more seriously the idea that we have political friction. So we have voting in this world that we think about. So we want to understand when we can implement taxes if the regulator needs to be voted, if these taxes need to be voted in, when we can see this type of carbon contingency emerge, and importantly, can they be equivalent? Can we substitute missing regulation with a financial market solution? Okay, very quickly on the model setup, we can invest in polluting and non-polluting technology. We have some types of, two main types of people in this world. Some are standard, they care about profits. Some are environmental, they care about carbon emission reduction. They care about green outcomes. And the regulator chooses to implement a tax subject to a medium voter constraint. And then we allow these people to lend and borrow among each other using this type of security design. So we have the first part, doesn't really matter, the RD, it's a fixed component of the payoff, but the second one does. What do we have there? We have E bar, it's a target level of emission, and E is the actual realized emission. So if you see here, if the E is lower than the target E, then basically you're gonna get a reward. This is essentially the payoff to the firm. But if you miss the target, you're gonna get a penalty. So long story short, you get rewarded or you get penalized if you miss your target. Okay, model predictions, and I'm wrapping up now. So basically, this kind of carbon contingent security design can be equivalent to a carbon tax. The point of the carbon tax, like we know, we would correct this laissez-faire economy in which standard agents invest in polluting technology, but the issue is that it has to be voted in. So when we don't have political support for implementing this tax, then these markets can emerge. And having these markets is welfare improving. If these markets are large enough, they can substitute completely substitute regulation, but there's a little caveat here because the existence of these markets can reduce political support for the tax, because the standard people who benefit from borrowing using these securities, they internalize, they can get rewards for reducing emissions. The green people feel happy to do this, and essentially welfare losses can occur when the reduction in political support that is brought in by market, this has been termed the dangerous placebo in the media, is more important than the emission reduction that markets enable, essentially. So yes, they can be equivalent, but there are issues. Okay, so to wrap up, I've made two, I suppose, main points. One related to the design of green securities. The optimal security would be a hybrid of what we currently observe in the market. And then the role of financial securities or markets in a world in which regulation is fragmented could be very beneficial and welfare improving, especially in those countries or markets where we don't have political support to implement a tax. And thank you so much.
Thank you, Adelina.
Hi, my name is Pooja. I'm from the Center for Transport Engineering and Modeling here in Imperial at the Civil Engineering. I just had a quick question about, this is a clarification, maybe I've got it wrong. You know, you had a slide on difference and differences on your regression model. You're reporting non-significant results. Is that, I mean, are you intentionally, failing to reject the null? Was that your intention? Or, because you don't report non-significant results, do you? Or insignificant ones?
Yeah, so that's our finding, right? We find non-significant results, and what I showed you after was also, you can change the specification in many different ways. You will find a non-significant result.
Was that your original hypothesis, though, that you were not?
We expected there would be
the
a shift, but we didn't find. Yeah, it was a null result, and then that's what the data says. Yeah.
Okay, so in terms of model prediction, do you use classification tables for post-estimation robust testing or in your methodologies? Because you're regressing, right? You're doing standard regression analysis. So I'm just wondering, for model fit, do you use rigorous post-estimation to find out about predicted probabilities, how good your model fits the data?
I mean, I'm happy to talk about some of the technical details later, but we do run like thousands of specifications and look at how many of those give us a significant result and which not. And that's our main way at the moment.
Yeah, and I was just curious because non-significant results don't get reported. And I'm just wondering whether that was your intention, is to
it's unusual. Usually there's a bias to report significant results, but in this case, we thought it was interesting to find out.
Just a clarification.
Can we go up there? There were a couple of questions.
Hi, Sahil Shah, Tipping Frontier. For the optimal green security design for an adaptation/resilience bond, would it be similar to what you've outlined for those related to emissions reduction? And how would it differ? Two reasons. One, given the disaster risk reduction benefits associated with adaptation and resilience, and often the change in risk exposure for the investor. And secondly, given the challenges in accurately measuring adaptation and resilience outcomes.
There was another question up there, I believe.
Okay, next one.
Hi, so Deborah Drea. I used to work for a company called Finastra that had a tool to help banks manage sustainability-linked loans. It's a question for Adelina. I was a bit perturbed to see that actually from 21 to 23, there were fewer of these done, and apologies if I missed it, but I was just wondering why. Is it because they're known to be manipulated?
Do we have any more questions before? Yes, one here.
Hi, Louise Wilson.
Well, can you wait for the mic so people can hear it? Sorry.
Hi, sorry, Louise Wilson. And Robin, a question for you on your research, whether or not you have presented it back to the banks or the lenders on whom you did the analysis to see what their reaction was to the fact that the pledges that they make are making no difference to their behaviour.
Okay, so Adelina, would you like to go first?
So thank you for your questions. Regarding the first one with adaptation, so let me see if I can conceptualize adaptation right. Would be something that you make an investment that would protect you against natural disasters, shocks, So I think it's a bit hard to think about an outcome contingent type of financing for that, because it's sort of, you do your best, right? You can put the appropriate safeguards in place to protect against natural disasters, but in some sense, verifying its success in terms of the outcomes of what happens after a natural disaster, it's a bit difficult. So I would say that probably for adaptation needs, a security like a green bond, where the pledge is on the safeguards or the protections that you're going to put in place to protect against natural disaster, would be more appropriate, because I don't know, I find it hard. Like the issue with an outcome contingent type of financing is you need to measure the outcome, right? So the outcome of your adaptation efforts, I don't know, it would have to be, I suppose, assessed in terms of what happened after you've done your best, but a disaster struck. So I don't know. It's a bit of a different problem, but that's what I can say now. I don't know if I missed other parts of your question. Regarding the drop in SLBs, I mean, relatively speaking, SLBs are similar to green bonds. If anything, there has been a decrease in appetite for the whole like debt market, but it's not like there was a collapse in SLBs only, but green bonds kept increasing. So I think the whole market, there has been skepticism expressed with regards to the entire market. Of course, with respect to SLBs too, greenwashing is a problem as we try to capture. But yeah, SLB green bonds have also been. I don't know why. Maybe they're practitioners.
Thank you, Adelina. Robin.
I think there was a question on whether we've presented this back to banks. So I want to compliment the organizers on creating an opportunity here to do this now. So I'd love to hear more, talk with more of you about this. I just want to caveat one thing. So I said it in the end very briefly, right? So we're not necessarily saying that these equator principles are completely ineffective, right? It's at the end of the day, it's a risk management framework. We're not observing the risk management practices, so they might have improved. So that target, we don't have anything to say about that. It could also be that they picked the type of brown projects that, where it's somehow easier to manage these risks. But if your goal is impact, then those results would say, yeah, that didn't work. But yeah, of course, the question, what is your target, right?
Let's have another round of questions. Yes.
Hi, so I'm working at a startup that does AI analysis of green bonds, so it's really interesting to hear your take on this. I was really pleased to see that you're using OpenAI tools to analyze the green bond market because it is very text-based data. And I was wondering, what is your opinion on how AI will hopefully shape this field or grow it, hurt it? What do you think AI will do to the green sustainable fixed income market?
There's some more up there.
My question is for Robin. Hi, I'm a PhD candidate in economics, and I really liked your topic. I just wanted to understand that you were presenting literature on how banks lend to brown and green firms and the differences in that. But you presented how how banks are financing green, neutral, and brown projects. Did you also try to find out whether there are differences in the lending depending on the firm, the kind of firm, like brown or green? Yeah, thank you.
Thank you. There's one here.
Michelle Horsfield, I work for a global bank. Robin, it's often said that academia shines a pseudo-light on a non-problem. I cannot understand why you chose the equator principles and linked them to loans.
Okay.
Sorry?
That's the question.
Could you elaborate maybe? So it's loans to projects, right?
So the equator principles we use as a risk management framework, basically to make sure we don't trash the planet as we finance something. And sustainability-linked loans, green bonds, they're used for different purposes. They're two completely separate things. I don't see how one follows the other. So I just wondered if you could explain why you chose that link. It didn't seem to make any sense.
Okay, there was one more question behind before we get back to that. And then we'll have answers to those.
It's better than I thought.
Hi, my name is Carol and I work for a real estate company. I've been leading the carbon accounting works for the company. And actually the carbon numbers is very closely tied to our sustainability-linked loans. And actually they are very diverse in a way because different matrices are linking to different loans that we are working with different banks. Then there could be even larger inconsistency in the market whereby different banks are issuing different types of SRLs to corporates like ours. Then what are your views on this type of inconsistencies?
Oh my God. Okay, let's have some. Robin, would you like to go first?
Sure. Let me try to defend the fundamental question of the. Yeah. So why we choose the equator principle? So it's a risk management framework for project finance, and our understanding is that these new requirements make it costlier to do brown lending to brown projects, and therefore we focus on that basically because it should make it costlier to finance a brown project versus a green project because you have tighter requirements how you do the risk management. Then there was a question about firm lending. So we specifically don't focus on firm lending in this project, right? So here we really look at, there are some of the other papers I looked at, I discussed in the beginning, they look at firm lending, and here we really look at project finance. So projects are typically organized as a special purpose, like as its own entity. It's not tied directly to a firm always. And then I think there was a question about AI and the use of AI. And yeah, one thing I'm quite excited about is exactly what you mentioned, that we can use this textual data in a much better way. Yeah, so I think this is one example, but that's the starting point. I think this opens up a lot of new opportunities in research to leverage this kind of textual data, which has been more limited so far. Yeah.
Adelina, do you have anything to add?
Maybe just to add on AI and the measurement of non-pecuniary outcomes that don't sum up to like a number. Of course, there's promise there. There are reasons to be excited that more generally that AI will improve our ability to measure qualitative, outcomes that cannot be reduced to numbers or money. That's all.
Okay, well, thank you very much to both of you and to the audience for their questions. Thank you.